kindly, James. Thank you for the warm welcome, and it is indeed a pleasure to join you here this morning in lovely London. As always, I'm greeted by snow coming down to London. Never fails this time of year, I must say. Here we are 2 months into 2014, and we've already been faced with all kinds of disturbing developments. And I'm not talking about Rob Ford or Justin Bieber or the polar vortex. I'm talking about the unrest we've seen in the Ukraine, a lot of very weak economic data for the US, and the fact that our own currency has dropped by about 5 cents just since the start of the year. Now, with that as a backdrop, and I always like to do this when I give talks, I'd like to just do a quick poll, a quick survey of you with your indulgence, and I'm just going to ask you whether you are optimistic, cautious, or pessimistic on the Canadian economy over the remainder of the year. And how I would define an optimist would be somebody who believes that the recovery will notably strengthen over the next 12 months, whereas a cautious person would believe that what we've seen over the last couple of years is about as good as it's going to get, and at best we're just going to kind of muddle along. And finally, a pessimist would be somebody who spends far too much time reading the Globe and Mail or watching CBC and thinks we're headed for an outright downturn over the next year. So with those unbiased definitions, how many people would consider themselves to be optimists? Show of hands, please. Any optimists in the room? Okay, we've got a few people from Bank of Montreal here, I see. Okay, maybe 10%. Instead, how many people would consider themselves to be cautious? Show of hands. Got a few Canadians in the room, a vast majority. Okay, and instead, any pessimists here? Not a one. Nobody watches CBC or reads the Globe and Mail. And you know, it's interesting how the markets have really shifted on that question in the last year and a half. We really have seen the pendulum swing. If you went back as far as, say, the middle part of even 2012, I think there was a real sense that the global economy could tip into another outright downturn. But we've seen those concerns fade, I would say, over the last year and a half. And even with the wobble that we had for equity markets at the start of the year, in recent days, the S&P 500 is back close to all-time highs. Even with the weakness in the Canadian dollar and some commodity prices, I think the overall sense in the markets is still relatively positive when we look over the next couple of years or so. And you know, despite all the headlines that we've seen recently, you know, all the concerns about what's going on in some of the emerging markets, I would like to just remind all of you about some of the positives that are still out there for the global economy over the next couple of years. First of all, in the US, we do have budget peace. They finally did reach a budget deal just the other month, and they agreed to raise the debt ceiling just a couple of weeks ago. So we're not going to go through another government shutdown such as we went through last year. We are not going to have any of these last-minute showdowns between the Republicans and the Democrats on that front. And behind that as well, we are seeing some improvement in the US economy. Equally important, I do believe the worst is over in Europe. That's not to say that the risks have completely gone away for the European economy. It's not as if Europe is going to come bursting out of the gates with strong growth, but it does look like, as an overriding risk to the global economy and global financial markets, Europe is fading in the rearview mirror. As well, there have been concerns that the Chinese economy could come in for a hard landing. Make no mistake, things have slowed in China, but it does look as if they pulled off the coveted soft landing, and we're still looking at about 7% growth for the Chinese economy in the year ahead. And just as a little added cherry on top, the world's third largest economy, Japan, has embarked on a number of very aggressive measures in the last year to try to kickstart their economy, and it does look like it's reaching some modest success on that front. Now, as I said, you know, it's not as if every cloud is parted. We do have all kinds of unsettling headlines coming out of the emerging markets, not the least of which is Ukraine and Argentina and unrest in Turkey. But overall, we think the bigger picture is that the global economy will actually gather a little bit of momentum in 2014. Now, just to put some of these numbers in context, if you can see them, the ones at the bottom right hand, a typical year for the global economy would be about 3.5% growth. And in the last 2 years, we've grown closer to 3%. It doesn't sound like a big difference, but a 0.5% miss is fairly significant for the global economy. Now, when we look into this year, we think that growth is going to nudge up a little bit and get closer to what we would consider to be the long-run average, and even move a little bit above that in 2015. And realistically, there are two important pillars behind our relative optimism over the next couple of years. First and arguably foremost is, as I said, we do think the worst is over in Europe. And after 2 years of seeing outright declines in activity in Europe, we're looking at growth of about 1% this year and something a little bit better in 2015 for Europe. Equally important, and perhaps more important to Canada, is that we are relatively optimistic on the U.S. economy itself. After a subpar year in 2013, we think the U.S. economy grows by closer to 3% this year and then a bit above 3% in 2015. As I said at the outset, we have seen a number of relatively weak numbers for the U.S. to start the year, but we believe that most of that weakness is directly attributable to the horrid weather that we've seen over the last couple months or so, and that looking beyond the weather effect, we think that underlying growth is closer to 3%, and that'll show through much more clearly as we go through the spring and the rest of the year. Now, for Canada, this is a very important development. Just a quick look at that chart will show you that despite all of the differences that we've seen between the Canadian and U.S. economy over the last 5-6 years, at the end of the day, where the U.S. economy leads, Canada will follow, give or take about 0.5% or so. Now, for most of the last 5 or 6 years, Canada's been on the good side of that, give or take 0.5%. Over the next few years, we think Canada will probably be on the negative side of that. In other words, we'll grow by about 0.5% or so less than the U.S. over the next few years or so. But still, that better growth in the U.S. we think will lift Canada to a somewhat better than 2% growth rate this year and again in 2015. Now, we think one of the big positive stories for the U.S. is underlying improvement in their budgetary situation, and I think this is one of the really underplayed positives that occurred in 2013. Last year, in a single year, we saw the U.S. budget deficit come down by more than $400 billion in one gulp, in 1 year. So for a number of years, the U.S. was running budget deficits of more than $1 trillion. And to me, that was actually one of the big risks to the global economy that was facing us. And yet last year, between big tax increases at the start of the year, very serious spending restraint, and even the government shutdown, they were able to reduce their budget deficit by, as I said, more than $400 billion in 1 year. So last year's budget deficit came in at $680 billion. Now, still a very large number, no question, but it's still improving even as we speak. And this year's budget deficit looks like it's going to come in at about $500 billion. As a share of their economy, that's about 3% of GDP. That's very, very close to sustainable. So effectively, the U.S. does not have to embark on huge additional tax increases, huge spending restraint to get their budget in order. It's already basically in order. Now, that's not to say there isn't work to be done in the years ahead. They're still going to have to control their healthcare spending costs, their Social Security costs, but really a lot of the heavy lifting has already been done on that front. So what had been a very clear and present danger for the global economy has faded to being a bit of a neutral factor, I would suggest. Now, another area of concern has been the weakness in their job market. At its worst, the unemployment rate in the U.S. got up to 10%. However, it has since come all the way down to 6.6%. In fact, the U.S. unemployment rate is now lower than it is here in Canada. That's the first time we've seen that in about 5 years. Now, unfortunately, a lot of that huge improvement that we've seen in the U.S. comes with a giant asterisk. And that asterisk is one of the reasons why the U.S. unemployment rate has come down so far, so fast in recent years, is that because the job market has been so weak in the U.S. that a lot of Americans have, frankly, just given up. Whether it's older folks retiring earlier than they normally would, or younger folks staying in school longer than they normally would, or people in the middle just giving up altogether, many Americans have become disengaged from the labor force, and there is a measure for that. It's called the participation rate. The participation rate is simply the share of the adult population, people 16 and over, who have a job or are looking for a job. And that's now at its lowest ebb since the late 1970s. And largely it's because people who can't find work are just leaving the labor force altogether. Now, we're seeing a little bit of an echo of that in Canada, but nowhere nearly to the same degree. And that's one of the reasons why our unemployment rate is actually now higher than the US unemployment rate, because Canadians have not become disengaged from the labor force here. So if you were to measure the unemployment rate on an apples-to-apples basis, the Canadian unemployment rate actually would still be almost a percentage point below that of the US. So make no mistake, Canada's jobless rate is still quite a bit healthier than that of the US. Now, I've also stacked up both unemployment rates internationally, and you can see that what stands out is neither Canada or the US really stands out particularly. We're both in the lower tier. We're well below some of those European unemployment rates. I mean, I did talk about how the worst is over in Europe, but take a look at some of those unemployment rates. Greece at 28%, Spain at 26%. I mean, that's a modern day depression that some areas of Europe are grinding through. However, there are some areas of Europe that have seen tremendous improvement in the past year. Ireland's unemployment rate has fallen by about 3 percentage points just in the last year. And take a look at who's got one of the lowest unemployment rates in the world. Germany, down there at about 5%. Australia is also a little bit better than Canada. But overall, both Canada and the US do fare relatively well when we compare ourselves to the rest of the industrialized world. Now, drilling down a little bit closer to home, you can see that Ontario's unemployment rate is a little bit above the national average, and London is another slight cut above Ontario's unemployment rate. Now, I don't think there's a big mystery behind why London and Ontario's unemployment rate is higher than the national average. It's largely due to the ongoing effect of the recession that we went through and the lingering impact that it's having on the manufacturing sector more generally. Now, I've stacked up, just for your interest, some of your neighbors' unemployment rates as well, Windsor and Toronto, and I think there's kind of an interesting little story that's developed here. And I do want to spend just a minute on this chart because I think it tells a little bit of an interesting story over the last 10 years or so. Take a look at the unemployment rates before the recession began on that left-hand column between Windsor, London, and Toronto. You find that London had the lowest unemployment rate in the southwestern area part of Ontario at 6.4%. Toronto was just a little bit higher, and then Windsor consistently had a higher unemployment rate than most of the rest of Ontario at 8%. Then during the recession, of course, the manufacturing sectors were hit particularly hard. Windsor had the highest unemployment rate in the country. During the recession year of 2009, it got up to an average of almost 14%. London got up to an average of almost 10%, and Toronto's also moved above the national average, but was the lowest of the three at 9%. Now, look at where we stand today. We've seen quite a bit of improvement in London. London's unemployment rate has come down by about 2 percentage points to 7.9%. It's still above where it was before the recession began. Toronto, however, has seen only limited improvement since that point. It's actually above London's at 8.5%. But take a look at your neighbor down the 401. Windsor's unemployment rate has actually dropped to 6.9%. It's plunged. It's actually below the national average, below the Ontario average. And one of the reasons why Windsor's been able to come back so quickly, besides the fact that a lot of people have actually left the city, is that the auto industry has made a major recovery, and they did not lose any major plants in the last couple of years. So we've actually seen a major cyclical recovery in the Windsor economy over this point. Now, shifting gears a little bit here, I have to tell you that one of the most common questions I get on the Canadian economy, and not just from Canadians, but from American investors, from European investors, from Asian investors, is this one: will the Canadian housing market calm, correct, or crash? Now, I have to tell you, a lot of people outside of this country are absolutely convinced that the Canadian housing market is just this giant accident waiting to happen. They're absolutely convinced that we're going to repeat the performance of what we saw in the U.S. They cannot believe that we can escape scot-free from what the U.S. went through in the last 5 or 6 years. And, you know, frankly, you'd be excused for thinking, if you walk by a newsstand within the last year, that we're already knee-deep in a major correction in the housing market, based just on this lurid cover on the front of Maclean's about a year ago, and inside the great real estate crash of 2013. And not to be outdone, Canadian Business asked, how low will house prices go? Why Canadian home prices will plummet by 20% and stay down for years. Well, I don't know what's in the coffee at these magazines, and I'm waiting for the 2014 versions to come out because we have a bit of a history here. Both magazines ran almost the identical covers back in 2012. In fact, I think that's the same house up in flames in early 2012 that's getting hit by lightning in 2013. And, you know, as I said, Canadian Business, not to be outdone, ran that lurid cover crash. But you know, the interesting thing is unlike those magazine covers, the reality has actually been much more mundane in the Canadian housing market. Now, before I talk more about the Canadian housing market, I do want to just spend a minute on the U.S. housing backdrop, because arguably this has been the economic story for about the last 6 or 7 years, the U.S. housing market. Because at the end of the day, it was the housing market crash in the U.S. that ultimately triggered the global financial crisis and led to just the devastating recession that the U.S. went through. And we have seen a real recovery in the U.S. housing market in the last couple of years. Whether you look at sales, home building, or home prices that are up nationally in the U.S. about 13% over the past year, we have seen a very real recovery in the U.S. housing market. Now, just recently, in the last 3-4 months, we've seen the U.S. housing market stub its toe. Home sales have actually retreated, and my pointer isn't strong enough to really show that, but home sales have retreated in the last few months or so. Some of it, again, is due to the very harsh winter weather. Some of it was due to the backup in mortgage rates that we saw last summer in the U.S. But the bigger picture is that the U.S. housing market is coming back together. And you know, what took 6 years to tear apart is not going to get put back together in 6 months. This is a recovery that will slowly build and improve over the next 3, 4, 5 years. And fundamentally, this is the reason why we think the U.S. economy will grow faster than the Canadian economy over the next 3 or 4 or 5 years, is because the U.S. housing market simply has much more room to grow than the Canadian housing market does, and we think this will act as a nice tailwind for the U.S. economy over the medium term. Very different story in Canada. If anything, Ottawa is still looking at ways to cool the housing market. In the last 4 or 5 years, Ottawa has stepped in 4 different times to turn the screw, to try to tighten the housing market, to try to slow things down. The last set of measures by Mr. Flaherty were back in the summer of 2012, where he tightened mortgage insurance rules, and initially it did work. We did see a slowdown in home sales. We saw a cooling off in home prices. But something very interesting has happened since last summer. Since last summer, we've actually seen the housing market start to strengthen again. We saw home sales pick back up late last year, and we saw home prices begin to accelerate again. And because of that, Ottawa again is taking a long look at new tightening measures for the housing market. In fact, this morning, CMHC is going to make an announcement. I'm not sure what it's going to be, but I wouldn't at all be surprised if it's some measure to try to cool off the housing market again. Because what we've seen is over the last year, almost every city in the country has seen a price gain. So the bar charts here show you how much home prices went up by various cities in the country in 2013. So unlike that cover, that screaming cover on the front of Maclean's magazine that called for a housing market crash, the reality is that 25 of the 26 largest cities in Canada saw home prices rise in 2013. The one city that did not see a home price increase last year was Victoria, where prices declined all of less than 1%. But as I said, the vast majority of cities saw home prices rise by about between 1 to 6%. Here in London, average home prices were up by about 2.5%. That was pretty typical. The average city saw prices rise by about 4%. Now, looking ahead, simply put, we do not buy into the downbeat, dour view. We think that home prices are not going to crash in the years ahead. We think the most likely outcome for home prices is that after a terrific run in the last 10 years, prices are likely to stabilize. They're going to struggle to see gains after inflation over the next 10 years. We cannot repeat the performance of the last 10 years. We think the most likely episode is that home prices are likely to basically go sideways for the next decade. Now, if you don't believe that home prices can just drift sideways, going up, neither up nor down for a full decade, take a look at what happened in the 1990s. Back in the 1990s, nationally, home prices effectively went sideways for 10 years in this country before they took off like a rocket in the last 10 years. But they can do that. They can go sideways for a long period of time. We think that that's the likely outcome, unlike those magazines that call for a big correction. Now, I will tell you that the rest of this chart does give me pause. It looks at average home prices in Canada versus the U.S. going all the way back to 1980. And what you can see is that for about 25 years, starting in 1980, home prices in Canada and the U.S. fit like about hand in glove for about 25 years and saw next to no difference from 1980 to the mid-2000s. And then we had this rupture back in 2006 where U.S. home prices went due south and are now almost 60% below their U.S. counterparts. Now, there's nothing in the textbooks that says that home prices in Canada have to be identical to what they are in the US. They don't. I mean, even within Canada, you can get very, very big differences between cities. Windsor and London have very different home prices. Toronto and London have very, very different home prices. They don't have to be identical. But a 60% gap is not sustainable, and one way or another, that gap will close in the years ahead. However, it's our view that most of the way this gap is going to close in the next 5 years is by US home prices coming back up, not by Canadian home prices plummeting down. Now, the nasty stepsister of those record home prices that we're seeing in Canada is we've also got record levels of household debt. Now, when people talk about household debt in Canada, make no mistake, they're talking about mortgages. Mortgages make up about 3/4 of all of household debt. It's mortgages that have really grown in the last 10 years or so. In fact, non-mortgage debt is growing at one of the slowest paces we've seen in about 20 years. Things like credit card debt, personal loans, those are barely growing at all. Canadians have actually done a very, very good job of consolidating their debt into mortgages. And I think that's actually good news, because mortgage debt tends to be some of the lowest cost. It's the most stable. It's backed by a very real asset. And Canadians have also done a very, very good job of locking in for 5 years. So they're relatively well insulated against any risk of a big pickup in mortgage rates in the years ahead. Now, what freaks people out is the fact that Canadian debt is not only at a record high as a share of income. We've got about $1.60 of debt for every dollar of income. That's an all-time high. But not only is that an all-time high, it's also above what we're seeing in the US, and that's very unusual to have Canadian debt levels above our US counterparts. Now, if there's anything I can say to give you comfort on that front, is that we've seen a real slowdown in debt growth. It's not just non-mortgage debt, even mortgage debt growth is cooling. And so in the last year, overall debt growth has grown by about 4%, which is getting very close to what typical incomes grow at these days. So we're very close to seeing that closely watched debt to income ratio finally beginning to top out and cool off. The other thing I would tell you is that when we look beyond North America, when we look at other countries, Canada is not some kind of weird outlier. We're not out there by ourselves. They're actually all kind of very successful economies that have higher debt levels than we do. The world champs on this front it would be Denmark. They have more than $3 of debt for every dollar of income at this point. And I have to tell you that, again, the United Nations have decided that the Danes are also the happiest people in the world. I don't know what the correlation there is, but other happy countries that have more debt than we do include Sweden, Netherlands, Australia has similar debt levels, as does Britain. So Canada is not some kind of, as I said, bizarre outlier on this front. By the way, I have to tell you, I was giving a talk a couple weeks ago in Etobicoke, and I made that point, and a gentleman at the end stands up and says that he's actually with the High Commission in Denmark. I thought he was going to take offense to my remarks, but what he told me is, he said, Danes aren't actually happy, we're just contented. So I wanted to set the record straight. Now, another topic of interest, of course, to Canadians recently, beyond the housing market, is our currency. The fact that it has dropped by about 10 cents in the last year alone. Do get a lot of questions over exactly how low is the currency going to go and what's driving it, and whether this is a flash in the pan. Is it going to return to parity anytime soon? I would simply tell you that I think the glory days for the Canadian dollar are over. I think over the last couple of years, when it was hanging in there at parity, it was overvalued. It was, I don't want to say it was an accident waiting to happen, but it was a matter of time before it began to retreat again. We had actually seen its commodity price fundamentals weakening underneath it for the last couple of years. Commodity prices actually peaked back in 2011. They've been weakening since that point. I know there's a lot going on in this chart, but the bigger picture here is if you look at a number of metals like gold, silver, copper, nickel, they all peaked way back in 2011 and been weakening since. So our main support for the Canadian dollar had been weakening for years. Now, not every commodity has been retreating. Natural gas prices have actually taken off since the start of the year, thanks to old man winter. Oil prices have actually held in very, very well. They've been hanging in there at about $100 a barrel. And of course, that is the single most important commodity to the Canadian economy. I do just want to do a quick sidebar on oil prices. I am relatively constructive on oil. And as I said, that is the single most important commodity to the Canadian economy. We see it averaging between $95 and $100 both this year and next year. But longer term, I do tend to favor oil over most other commodities. Many people look at that big increase in U.S. oil production in the last couple of years. It's increasing at the fastest pace that we've seen on record recently. The U.S. is set to become the world's largest oil producer over the next couple of years. But I look at that and look at the fact that oil prices are still at $100 a barrel, and I see that as very constructive for oil prices. And the fact that they've been able to hang in there at about $100 a barrel, even when the U.S. has cranked up oil production as it has in the last couple of years, to me is actually a very positive development for the oil market. Most other commodities I'd be a little bit more leery of over the next couple of years. I think at best they'll move sideways for the next couple of years. So we simply think that the commodity price support is not going to be a big positive for the currency over the next couple of years. As well, at the same time, we've had a fundamental shift in how foreign investors view Canada. Now, I want to spend just a couple minutes on this chart because I think it is relatively important. Over the last couple of years, say going back to the early years after the recession ended, 2010, 2011, 2012, foreign investors took a look at what was going on in the U.S., their very slow recovery, the fact they were running a $1 trillion budget deficit, all the problems the U.S. had. They were taking a look at that. They were taking a look at Europe and their debt crisis. They were taking a look at Japan and its very unfavorable demographic situation, and they were ticking none of the above. They weren't interested in investing in any of those places. So basically, investors were looking for relatively safe and sound AAA rated economies. Places like Canada, like Switzerland, like Norway, like Australia, and that's where they were pouring their money in the last few years or so. So for a few years, we were seeing more than $100 billion a year coming into this country, into our bond market. It wasn't anything fancy. They weren't buying stocks per se. It wasn't so much they were buying companies. They were just buying our Government of Canada bonds, our Government of Ontario bonds, our Government of BC bonds to the tune of more than $100 billion a year. And a lot of this was just a classic diversification play away from the US dollar, away from the euro, into the Canadian dollar. Now, we're still seeing inflows, but they have slowed dramatically. They're down to about $40 billion a year. And meanwhile, Canadian investors who wouldn't touch US equity markets for a few years there after the recession are now looking at those big returns in the S&P 500. They're looking at those record highs that we've seen on the Dow, and they're starting to invest abroad again. And so what had been a net outflow, a net inflow on the order of about $100 billion for a few years has now gone down to almost nothing. So what had been a huge support for the Canadian dollar has basically gone away just in the last 12 months or so. So when we look ahead over the next year or so, we think that there's probably more negatives out there for the Canadian dollar than there are positives. I said that it actually traded above its fair value for commodities for a few years. It's pretty close to what I would consider to be fair value at around 90 cents based solely on commodity prices. But we think that there are a number of underlying negatives that actually could lead it to trade below fair value over the course of 2014. Now, as we get back into 2015, we think that there will be some factors, I'll get into one in a minute, that we think might lift the currency closer to 90 cents. But longer term, when we get beyond 2015, I tend to just believe that the currency is more likely to soften rather than strengthen. Now, I've listed some of the big drivers there that we look for the Canadian dollar over the years ahead. And just to pick to a couple, as I said, I think commodity prices at best are a neutral for the currency. Balance of payments have gone from being a big positive to at best being a neutral. And on the global trend side, we think that the US dollar itself is starting to make a fundamental comeback, and the flip side of that is that the Canadian dollar is more likely to soften than strengthen in the years ahead. Now, this chart is meant to be more humorous rather than anything else, but I do find it rather amusing that for a number of years the Canadian dollar traded exactly in line with the UK pound. I mean, every time the pound went up, the Canadian dollar went up. Every time the pound went down, the Canadian dollar went down for a number of years. And then after Mr. Carney left in the middle of last summer, you can see what's happened to the Canadian dollar since he's left. Basically, since the middle part of last year, the Canadian dollar has dropped about 10 cents or so. Well, then a month later, of course, he went and joined the Bank of England. You can see what's happened to the pound since the middle part of last year. It's gone nowhere but up. I tell you, the man walks on water. We've seen, in fact, if you had followed Mr. Carney, you would have made about 20% on your money in the short space of about a year. Now, the weakness in the Canadian dollar will have an impact on our inflation rate. The new the new Bank of Canada Governor Stephen Paul has actually come out in the last couple of months and said that one of his biggest concerns has been the fact that inflation has been too low for comfort. Well, just this past weekend, he gave an interview from Australia, and he suggested that he's a little bit more comfortable with inflation because we've actually seen inflation start to creep up. It hit 1.5% in January. And our view is that with the currency now beginning to weaken, we will see a little bit of further upward pressure on inflation over the next year and a half. In the last couple of years, there has been this incredibly intense retail battle going on in Canada, partly because Target moved into Canada, partly because of the threat from cross-border shopping. The fact that Canadian consumers could look at those lower prices in the US, that was like a cudgel over our retailers, the fact that it was putting real downward pressure on Canadian prices here in Canada. With the Canadian dollar weakening, though, as I said, closer to fair value, a little bit of that pressure has been relaxed on Canadian retailers. And we, excuse me, and we think it's more likely that inflation will tend to gravitate higher over the next year or 2 years. Now, when you're doing your medium-term planning, I still think it's reasonable to assume a medium-term average inflation rate of about 2%. Keep in mind that that's what the Bank of Canada targets. They've been targeting inflation since the early 1990s, and since they began targeting inflation, it has averaged almost 2% on the button. So I still think that that's a reasonable anchor for your medium-term plans to assume inflation of about 2%. Now, when we look around the rest of the world, you can see that most major industrial economies do have inflation of around 1% or a little bit higher at this point. This, again, is not particular to Canada. The US also has an inflation rate of about 1%. Britain, Japan, Euro are all in that area of around 1 to 2%. Now, that, though, having relatively low inflation is very much a rich world story. Take a look at some of those inflation rates in the emerging markets. You've got China there at about 2.5%, Brazil at about 6%, India up at about 9%. So unlike in the industrialized world, low inflation is not a story in the emerging markets. And I'll get into it in a minute why we think that's relatively important. Now, the last question I'm going to deal with, or the second last question I should say, is what does this all mean for financial markets? We've talked about the growth backdrop. We've talked a little bit about the Canadian dollar, about the housing market. Well, what does this mean to you as an investor? What does it mean for interest rates? What does it mean for the equity market? Well, I have to say, as an interest rate forecaster, life has been rather easy for the last 4 years or so. The Bank of Canada has not shifted its interest rate policy since September of 2010, and we do not see a move by the Bank of Canada over the course of 2014 either. The Bank of Canada decides on interest rates 8 times a year. One of those interest rate decisions will be next Thursday. We think they're going to come out and say that their overnight rate will again stay at 1% there, as it will through this year. We do not see the Bank of Canada raising interest rates until late 2015. And even then, they're going to take it very, very cautiously. We see a 0.5 percentage point increase in rates in the second half of 2015. Now, I fully appreciate that not everybody in this room is thrilled by the fact that interest rates have stayed so low and so stable for such a long period of time. I appreciate that might be frustrating to some people in the room. But the heavy, heavy anchor on Canadian interest rates is what's going on in the world's most important interest rate, the US overnight interest rate. It's effectively been locked at 0 since the financial crisis broke wide open in late 2008, and there's no indication that US interest rates are going anywhere over the next year. We don't see the Fed raising interest rates until the very end of 2016, and again, even there, they will be very, very cautious and deliberate in their interest rate increases. Now, those are just the overnight interest rates. That's what drives your prime lending rate or your variable mortgage rate. Longer term interest rates, we actually have seen a little bit of movement in the last year or so. Last summer, just the whiff, just the hint that the Fed was even considering starting to grind down their aggressive bond buying policy, QE3, just the whiff that they were going to begin to taper it, led to a ratcheting up of long-term interest rates. Now, I've charted the 10-year bond yield here, but almost every major bond yield moved higher last summer. They rose by about a percentage point in the short space of about 3 months. Since that point, they've tended to flatten out a little bit. We haven't seen a lot of movement in the last few months or so. But we think, based on our forecast, that the U.S. economy will come back through the rest of this year, that the Fed will continue to taper its bond buying as we go through this year, that the underlying trend will be towards higher long-term yields through the rest of this year. By the end of the year, we see the U.S. 10-year Treasury at 3.5%, and then at the end of 2015, we see it rising another half percentage point to about 4%. So my best guess is that, say, a 5-year mortgage rate in Canada, which are based on these, pretty closely based on these 10-year yields, we believe that by the end of this year, a 5-year mortgage rate will go up by about a half to 3/4 percentage point here in Canada, and then probably up by about another 0.5% again in 2015. Now, of course, there is some concern in financial markets about what the implication of the Fed unwinding its QE3 might mean for equity markets. And you know, this is QE3. This is the third time that the Fed has embarked on this so-called quantitative easing. We've had 2 other real-world examples of what happens to financial markets after the Fed stops its bond buying program. One back in 2010, one back in 2011. And in both cases, again, a lot's going on in this chart, but the main message I want to leave you with is at the end of both of those episodes, we actually did see a correction in the U.S. equity market. Now, there was a lot going on. It just so happened that after both of those episodes ended, the European crisis was also flaring up for a variety of reasons. So we did see a correction in the U.S. equity market at the end of the QE1 and QE2. But the other thing that we also saw is that the equity market, after that initial correction, flattened out, picked itself up, and began rising again. And we think that that's what's going to happen this time as well, is we think that ultimately the economic fundamentals will override whatever the Fed is doing, and that if we're right on the economic backdrop, we would still be relatively bullish on the equity market through 2014. Now, our equity strategist, Brian Belsky, does remain relatively constructive on the S&P 500. He does continue to favor U.S. equities over Canadian equities at this point. The U.S. equity market has blasted beyond the Canadian equity market for the last couple years. We do think that it's going to be a little bit more of a horse race in 2014. The one thing I would direct you to on the 2014 chart is take a look at which equity market actually is leading the way so far this year. Yes, our very own equity market has actually held up much, much better than most of the others in the rest of the world. It has been a very, very shaky year for the emerging markets in particular since the start of the year. But I will tell you that this did follow a phenomenal year for global equity markets in 2013. I mean, these 2 charts are not on the same scale. Those were just terrific gains that we saw across the industrialized world in 2013. Japan up there with a better than 50% increase in 2013. The U.S. equity market up by about 30%. That was one of the best years in decades for U.S. equity markets last year. So you can make the case, I think, that equity markets, especially in the U.S., might have gotten just a little bit ahead of economic fundamentals by the end of last year. And so it wasn't too surprising that we saw a little bit of a minor correction at the start of 2014. But as I said, our strategy is relatively constructive through the rest of this year based on the economic forecast that we're looking at. Last topic, just one last thing. Just some of the things to keep on the radar for 2014. Of course, we've already had a few developments unfold just in the first couple months. On the economic front, one challenge that we're going to see for the Japanese economy is they're going to lift their sales tax at the start of April. We've seen this before in Japan. It happened back in 1997. The Japanese economy did not react to that well when they hiked their sales tax back in 1997. We think the market's a little bit better prepared for that this time. There's all kinds of political issues for this year. There's no real blockbuster event. There's not a Canadian federal election or a U.S. presidential election. However, we do have a midterm election in the U.S. It is potentially important because the Senate could shift over from the Democrats to the Republicans. That would give the Republicans both sides of Congress if that did happen. Of course, at the provincial level, we could have elections in both Quebec and Ontario, almost certainly in Quebec, most likely in Ontario. And also, just as a little bit of interest, we do have the Scottish independence vote in September. Who knows? That could set as a template for Quebec in the years ahead, depending on what happens in that vote. Last topic I'll just touch on very, very briefly is, well, what does this all mean for southwestern Ontario? What does this economic forecast mean? I put up some of what I believe to be the major growth drivers. Most of those are short-term cyclical factors. The lower Canadian dollar will certainly help the manufacturing sector, at least provide a bit of relief. We do think the single most important factor at this point is the stronger U.S. outlook. that we're looking at. The fact that the U.S. economy will be growing closer to 3% is a big, big positive for southwestern Ontario. No question the region still faces very serious challenges. Even with the drop in the currency, unit labor costs are relatively high in Ontario versus much of the rest of the industrialized world. And Ontario still is saddled with a relatively large budget deficit. We are still going to see very real restraint at the provincial level in this province, which will tend to dampen Ontario's broader growth rate. And when we stack up the Ontario growth rate, we are expecting Ontario to grow close to the national average in terms of overall GDP. That's actually an improvement for the last couple of years when Ontario was growing slower than the rest of the country. Ontario is the most levered province to the U.S. economy. It does stand to benefit the most from the pickup in the U.S., and that's simply why we think the Ontario economy will grow more closely in line with the rest of the country over the course of 2014 and 2015.